Hello, welcome back to this week's market update. Today is Monday, April 29th, 2024, and we had a very full week full of earnings as well as some really important economic data. So we will jump right in. Last week, markets got a rebound in stocks driven by the impressive earnings of large cap technology names like Tesla, Microsoft, Meta, and Google, sending the Nasdaq Composite up 4.23% on the week, the S&P 500 up 2.67% on the week, the Dow Jones Industrial Average up 0.67% on the week, and then the Barclays Aggregate Bond Index just about flat to close the week. Shifting gears into our economic data of last week, we got the PCE inflation report for the month of March, which is really important as we come up on a Fed meeting this week on May 1st. So looking at the PCE inflation report for the month of March, it did come in hotter than expected, just like the CPI and the PPI. And you can see here we had a headline PCE inflation rate of 2.7%, which was a slight uptick from last month. It's actually the highest annual inflation rate since November of 2023. And then we had core PCE just flat at 2.8% from a year ago. Both headline and core PCE was up 0.3% month over month, so that wasn't too bad on that front. But then when we look at kind of how it breaks down into the goods versus services category, we're really seeing the impact of service inflation continue to weigh on these higher prices. So goods inflation was up only 0.1% from a year ago, whereas services inflation was up 4% from March of 2023. So ultimately, it has been really that sticky service inflation that we've been seeing. And that also ties in with the next data that we're going to look at, which is the personal income. Also, with the PCE inflation report, we get some great data on personal income, spending, and savings. Also for the month of March, and you can see that disposable personal income, which is income after taxes, was up 0.5% in the month of March, which is quite strong. It actually outpaced the 0.3% PCE inflation, and that kind of explains some of the service side inflation, as a lot of wages are closely related to services and the increase in service costs. So, seeing some great wage gains in this month's data, but that doesn't come without inflationary pressures alongside it. And then also looking at the personal outlays, those were up 0.9% month over month, which is quite a bit of a jump. And then when you spend more than what you make, obviously the personal savings rate is going to fall, and that actually fell to 3.2%, which was the lowest personal savings rate since October of 2022. So ultimately, this shows a mixed picture of the economy. Are consumers spending more because they have to, or are they spending more because they feel good about the economy and they're feeling these wage gains and they don't mind spending a little bit more because they have confidence in the economy, keeping their job, and those sort of things? So, paints a really interesting picture that we'll continue to monitor about the economy. Another data point we got last week in terms of economic activity was the first estimate of first quarter real GDP. So, looking at the data right away, we got a 1.4% annualized growth rate in the first quarter of 2024, which is not as good as most economists as well as the Fed was expecting. So, it was fueled mainly by an increase in consumer spending as well as residential and non residential fixed investments, as well as state and local government spending. On the other hand, this growth was offset by a decrease in a private inventory investment, which is not a great sign from the manufacturing industry, as well as a decrease in net exports, as imports saw a small uptick during this quarter as well. So ultimately, it was not a great report for first quarter GDP. Came in a bit slower than expected, and it was mainly driven by consumer spending and government spending. We are going to continue to monitor this, see how it is revised up or down in the coming months, and continue to keep an eye on economic activity. Also, last week we got the new home sales data for the month of March that showed 693,000 new homes sold at a median sales price of 430,700, which was a bit of an uptick in the month of March. You can see that sharp uptick right here in the median price of the new home sold. However, it has been on a downward trend really since the end of 2022, early 2023, when new homes kind of peaked out near this 500,000 levels. Not a great environment for new home builders. We're seeing a very interesting confluence of factors with pent up unserved demand colliding with limited supply, as well as higher borrowing costs. So, just a very unique housing environment, and this data surely shows that. Beyond the housing sector data, we also got durable goods orders for the month of March coming in at 283 billion, which was up 2.6% from the month prior. However, when we look a little bit deeper into the data, the transportation sector led this growth up more than 7% during the month. And then when you factor that out of the durable goods orders for the month of March, that shows durable goods up only 0.2% month over month. Not super great growth when you exclude the impact of transportation. However, even within the transportation category, we saw a really significant jump of 30.6% in new orders of non-defense aircraft in the month of March, which is really big, driving growing backlogs faced by aircraft manufacturers like Boeing, Airbus, and all of their upstream partners in the supply chain. So, overall, we did see a fairly strong uptick. However, this was extremely concentrated in the transportation and aircraft sector. One final update from last week is just a quick touch base on first quarter earnings. Out of the S&P 500, we've had more than 40% report as of close on Friday with an average earnings growth rate of 1% across the index. However, this was very much company specific. It's not a rising tide environment anymore. It's very industry and company specific in terms of earnings growth and overall performance in earnings that we've seen in the S&P 500. So names like Tesla were up 14% last week as they had a pretty strong quarter of earnings, although it was down from a year ago on both top and bottom lines, but they were up 14% on the news that they were going to really hone it in on the idea of lower cost electric vehicles. Then we also saw names like Google rally last week, up 11.6%, as they had a really great quarter of earnings, seeing a lot of their investments in AI pay off. Microsoft up slightly, they had a pretty good quarter as well. And then the final name of the mega cap tech reporting companies last week, Meta, they had a kind of less than rosier picture, down almost 8% last week, as Mark Zuckerberg, the CEO, really focused on the investments they were going to be making in the metaverse, in AI, and kind of the very research and development cost heavy initiatives that they are prioritizing. So, overall, a very kind of neutral quarter with this 1% growth rate, but has been very company specific as well. Thank you so much for tuning into our market update this week. We look forward to providing another update with some great data from the Fed, as well as the employment numbers for the month of April that we'll get at the end of this week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.